Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation, very timely topic, and I think you'll really appreciate the education that you'll get today. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries today during or after the webinar as appropriate. If you ask a question in the chat box and we're not able to get to you, please go ahead and leave your phone number as well. We'll make sure someone reaches out to you after today's event. Once again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Our moderator today is Sean McElderry, who is the CEO and founder of Monarch Wealth and Retirement Strategies. He is a certified financial fiduciary and has 22 years of experience in the financial services industry. As financial professionals, Sean and his team are committed to helping people create solutions for their retirement assets. Once they understand risk tolerance, time horizon, and goals, they work to develop a program that carefully balances investment strategies with preserving principle. And Sean, why don't you come off of mute and say hello so people can see your face?
Hi, everyone. Thank you for joining today. Look forward to speaking further with you guys, and hopefully you get something out of this.
I'd love to introduce you to our presenter today. Carly Chauhan is a certified public accountant and partner at the LSC Group, and she earned her bachelor's and master's from the University of Miami School of Business. Many people have so much going on that they really don't focus on their tax and financial planning needs, and Carly and her team find solutions that allow you to achieve your tax and financial goals, allowing you to spend more time doing what you enjoy without having to worry about your tax future. Carly, we're really excited to have you here, and I'm going to go ahead and turn the time over to you.
Hi, everybody, and I also wanted to thank you all for coming and participating today. Thank you to Sean and Advice Chaser for having me. I really want to take the time we have here together to not only discuss ways that you can get a head start, but also ways that you can make what is sometimes a very daunting time of year a little easier for you as well as your CPA. A little selfish plug, but yeah, it's for all parties involved. So the first, and I think the most obvious part of the whole process is just getting your information together. The first, and I think the easiest piece is your government documents, your W-2s, your 1099s, your 1098s, those forms that we receive directly from the various governmental agencies or from our companies. Those are, again, pretty obvious and something that the CPA definitely needs. A couple new items that actually you're going to be receiving potentially this year are also some letters from the IRS, Notice 1444C, which is going to report how much, if you did receive any of your third stimulus payment, that would have been in 2021. And then also IRS letter 6419. And this letter will report the amount, if any, that you receive for the advanced child tax credit payments. So again, new this year, if you receive them, please definitely pass them along to your accountant. Some of the other stuff that doesn't come as easily, that does require a little bit more work on your end, the taxpayer's end, is the gathering of such things as your itemized deductions. How much did you spend on your medical expenses this year? Your property taxes, your charitable donations, etc. So really now is the time to make sure you have all that gathered up and tallied up for your preparer. And lastly, for those business owners, make sure that your books and records are completed through 12/31, that you have recorded all of your income, your various expenses, bank and credit card accounts are all reconciled, and that the accountant, can then take your information and begin the process of preparing your tax returns and/or extensions. Hopefully, this is not the first time or the only time that you speak to your accountant or your CPA or tax preparer during the year. As I spoke about in a previous webinar, the end of the year, the year-end planning, that's really where we do the bulk of our work, meaning that's really where the taxpayer can receive the most value from their tax professional. But if you didn't have that opportunity or you missed some deadlines, there still are a few things you can do that will help you save some taxes. So the first one there are retirement contributions that still can be made by the end of the year. That can be made by tax deadline. We have the IRA, traditional IRA, the Roth IRA, SEP IRA. So if you are qualified, if you are eligible for those particular IRA accounts, speak with your tax professional, find out how much can you contribute and what is the deadline for those various retirement contributions. Home office, pretty sure most of us out there have been working from home during 2021, if not full-time, at least part-time. You may be entitled to a home office deduction. So again, something to talk about, something to look into with your tax professional. Lastly, dependents. Does it make sense for your potential dependent to file their own return? Are they actually your dependent? Should you claim them on your return? Again, some planning that can be done. Big one here would be tuition credits. If your adult child is a student and you're not paying for them for anything anymore, no living, no school, they may be eligible to file their own return and could potentially get a larger credit if for the tuition that's spent. So again, something to think about, something to talk about. One note I do want to mention with the retirement contributions, you can actually now contribute for federal purposes, no matter how old you are. There used to be a limit, age 70 and a half, but now it doesn't matter. California, however, for any of our California or other states, they may not conform to that rule, so just be aware. When I was talking to Sean as well as Marche about, what do I really want to kind of talk to people about, and the participants today on today's webinar, and for me, it was kind of these best practices. Again, selfishly, a little bit to help me and my other CPA colleagues out there as far as to make tax season a little easier, but also it's really to make you, the client, make this process as painless as possible. So the first, and I think the easiest one here, is don't wait until the last minute. Yes, right now we are in a busy time, but in March and in April, it's even busier. So now really is the time to be gathering that information. Your 1099s, your tax information should be coming in right now. Start gathering that, start getting that, together now, not when your CPA emails you on March 15th or on April 1st saying, hey, where's your stuff? Keeping contemporaneous records is another big one. If you can be keeping track of your medical expenses, your charitable contributions, your various business expenses throughout the year as you are incurring these costs, you don't then have to wait until January or until February to begin going back a year and putting this stuff together. So if throughout the year you are keeping these records and you are tallying them up, maybe week by week, month by month, whatever it might be, that'll save you time. It will also save your CPA time. Lastly, and another little tidbit here is, God forbid the IRS does come knocking and you have these contemporaneous records and it's obvious that this is something you've been doing throughout the year, the IRS auditor is going to most likely be a lot easier and a lot more accepting of the information you provide them. As I mentioned, tracking charitable donations. If you do make charitable donations of $250 or more, so totaling $250 or more to an organization throughout the year, they are required to send you a letter that will document how much you've contributed to that organization throughout the year. However, if you're just donating $10 or $20 to various organizations, they're not going to send you a letter. So it's a good idea to save those emails or save those receipts and keep track of them, add them up so that, again, you can provide this information more easily to your tax preparer. Next, we have the mileage record. So again, people are always talking about, well, I do use my car for business. Now, first, I want to define, what does that mean? Driving to and from your office is your commute. That is not business. So this would be things such as driving to clients, driving to vendors, driving to various seminars, whatever it might be. That is going to be business use. So keeping track of these miles as you're going is a lot easier, again, than going back a year. There are apps nowadays that can keep track of all this information for you. Or if you want to use a calendar and write down how many miles did you drive, whatever the method, it doesn't matter. It's that as you're going along, you're keeping track of this. Again, makes it easier for you, makes it easier for tax preparer. A trick that I like to tell my clients is using their year-end summaries. And I'm sure you all have a credit card that at the end of the year sends you a year-end summary, and it will break out into various categories: medical, charity, office supplies, auto, etc. So using your credit card for some of these expenses may help you in keeping your contemporaneous records, because it is going to summarize these totals for you throughout the year. So again, providing this information to your tax preparer or just using it in order to complete your tax organizer really saves you time, and also will give you some pretty good and accurate information. Filing extension if appropriate. I try, when I bring on a new client, one of the first things I like to teach my clients is filing extension is not a punishment. And in fact, it can potentially provide you with extreme benefits. The biggest one being having your preparer work on your tax return in May, June, July, even August, when they have time, when they have energy, when they have the ability to really focus on you, they have the bandwidth, can actually end up helping you immensely by finding various deductions or tax law or even credits that you might be eligible for that, in the rush of things may have been missed, or just you may have not had the opportunity to sit down and discuss together. Again, an extension is simply an extension to file the return. It's not an extension to pay. So you still do need to provide your tax preparer sufficient information for them to calculate an appropriate tax liability so you can make the appropriate payment. One other thing I do want to mention is that if you have a refund coming, obviously you're going to want to file that return as soon as possible, because you want that refund as soon as possible. One more reason to just get that information as quickly and timely as possible to your preparer, so that they can prepare that return for you and get you that refund as soon as they can. A question that I'm often asked is, how long do I need to keep my information? So first and foremost, it's the information that was used on the tax return. So if you are, deducting your medical expenses, you need to keep, the substantiation for those medical expenses. If you are not deducting medical expenses, maybe you don't have enough, or, whatever it might be, you're not itemizing, you don't need to keep it. So if you are keeping the information, the IRS requires you to keep the information for 7 years. Electronic copies are totally fine, does not need to be paper copies. Now, there are other reasons for sometimes keeping backup longer, such as payroll reports. So I would recommend asking either employment attorneys or other, HR representatives, do I need to keep any of this information longer than 7 years? Because again, there might be statutes that are longer and that, you may have a different requirement. But when it comes to taxes, the rule is 7 years. So as I said in the beginning, a little of this webinar is selfish in that I really want to try and again, make this easy for the taxpayers, but also for the tax preparers. So some of the pet peeves I wanted to share with everybody today is, as I mentioned already a few times, get your stuff in early. Don't wait until that last minute. You also don't need to wait until you have every single piece of information. As I said, if we're going to be preparing an extension for you, we do need to calculate the liability. So even if you get me 80% of your information, that's going to get us a good number that we can help you. So again, you don't have to wait till that last minute. At the same time, submitting documents piecemeal can also be a little bit of a burden for the tax preparer, not only because they're going to get 7 million emails, but something may get lost. We have been using online portals, which is a great way for clients to submit. That way they can be submitting piecemeal because it's all kind of going into that portal, and the preparer will be able to get that information when the time comes. But if not, again, sending a bulk of information at a time, I think is usually a best practice. Again, selfishly here, I want to mention it does get busy. March and April are those 6 weeks from, I would say, March 1st through April 15th is the CPA's typically busiest time of year. So again, allowing us to have the bandwidth and the time to fully review and analyze your return is really where you are going to get the most value. And that typically comes with filing that extension, waiting until you all have the time to sit and think and talk it out, as opposed to rushing through and getting it, by that April 15th deadline. And lastly, CPAs email our clients, hey, did you think about this? I'm missing this. Do you have any of this deduction this year? When we're sending those emails, being able to respond as quickly as possible really helps the process. Not only is, to get your tax return done quicker or your extension done quicker, but also, it's kind of fresh in our mind. We've been thinking about you and about your account. And so the quicker you can respond to us, the quicker maybe we can come back with additional tax saving opportunities. Again, our goal is to provide the best service and the best value to our clients. And so hopefully by following some of these tips, these best practices, and avoiding the pet peeves, you'll be able to make the process, again, not only easier for you, but also for your preparer, which will hopefully result in a better tax situation ultimately for you.
All right, we're going to go ahead and take some questions now. I know we've already got some in the queue, so I'm going to turn the time over to Sean and Carly to address those.
Okay, so one question is, someone's asking if they really need to keep their tax records for 7 years. They heard 3, and I know there's a couple different rules around that. Carly, can you talk about that?
Sure. So the 3 years, I'm going to guess there's the statute of limitations, and that's when the IRS can come and audit you. So for the IRS, it's 3 years. For the state of California, that's 4 years, and various other states have different rules. However, there are extenuating circumstances where that actual statute can not exist. For example, if you don't file your tax return, there is no statute. And so if you don't file your tax return and they come to you and they find that you didn't report income, there is no statute and they can go back forever. So again, we do recommend that you keep your documents for 7 years.
If you want to contribute to an IRA or a SEP, if you're a business owner for 2021, what deadlines do I have to contribute until?
Sure. So for the traditional IRA, the Roth IRA, and the SEP IRA, the answer is April 15th. However, the SEP IRA there is an extension for that particular contribution, and that is with the due date of the tax return. So if you are a business owner, it depends on your business. So again, if you are a sole practitioner, it would be 4/15 and 10/15. If you are an S corporation, it would actually be March 15th or it would be September 15th. So again, due date of the tax return plus extension. For SEP IRA only, regular IRA must be, traditional or Roth IRA is 415, no extensions.
Okay, and another one here would be around medical. Asking if you talk about the deductions for medical expenses, is there a threshold? And with so many people working from home now, what sort of deductions are allowed if you are an independent contractor or W-2 employee?
Sure. So the medical expense question, it's 7.5% of your adjusted gross income if you are itemizing. So, typically you have to have substantial medical expenses in order to get a deduction for those. However, when it comes to your insurance premiums, if you are self-employed or if you are a business owner, you can get a deduction for those, for your employees as well as for yourself. So that is something treated differently, and that is something to make sure you do mention to your tax preparer.
And just to clarify that, if
Sure.
you have employees, then that would mean you could get a deduction if it was through like an employee benefits program you set up for everybody, including yourself.
Correct. So if you provide health insurance for your employees, their premiums, your portion, what you're paying, plus the employer's portion is deductible. There are other plans that an employer can create where there is some sort of reimbursement for employee health insurance premiums. Those are, again, the employer has to have it set up in a very particular way. There's very strict rules about that. So more often than not, the employers are providing the health insurance, or it's just not an expense that the employer takes on.
Okay, so then I guess the second part of that was, with so many people working from home, what sort of deductions are allowed if you are independent contractor versus W-2?
So for W-2, for federal purposes, there's really none. With the TCJA, so the Tax Cut and Job Act that was put into place in 2018, it eliminated those business expense deductions for W-2 employees. There are some states, however, where you may be entitled to a benefit. So again, something to look into. When it comes to independent contractors, they have much more flexibility because they are not a W-2 employee. So home office expense, for example, let's say you own your home and 10% of it is used for your office, you then can take 10% of the expenses. So let's say utilities, mortgage, property taxes, etc. Again, the 10% would be the square footage of the office versus the total square footage of the home. Keep in mind, your office is an area that is used exclusively for business. You can't say it's your bed. You can't say it's your kitchen table. It has to be an exclusive area that is used for work.
Okay. Can you talk about the moving expenses? I am aware that the deductions for moving expenses are now only for military. I guess my question is there anything I should do in regards with that? I reviewed one of my pay slips, which consists of the tax gross up payment from my employer. What would be its effect on my tax return? Thanks.
Right. So the moving expense deduction was also eliminated with the TCJA. However, there are some states that still do allow it. So what I would do is, depending on your particular state, see if you are eligible still for that deduction there.
Okay. Two more. One, someone's asking about student loan interest deductions. Can you talk a little bit about that?
Sure. Student loan. So again, there is a threshold as far as if you are entitled to the deduction. So again, typically higher earning taxpayers are going to get little to no benefit for that. The maximum is, I believe, still $1,500 for the deduction. But again, the limit, the income limit is relatively low. So most taxpayers do see that phased out pretty quickly.
Okay. And then if you look at the standard deduction having been raised in recent years, does it make sense to itemize if you aren't going to hit that threshold?
So the IRS, again, it allows you to take the greater of. So definitely keep track of your expenses. If you have mortgage, if you have property taxes, you need, definitely compare, because maybe some years you have more, maybe some years you have less, but either way you get the greater. Now with charity, that is an area where you can kind of play with it. First of all, if you, whether you itemize or whether you take the standard deduction, the IRS is allowing for a $300 or $600 for married filing joint above the line deduction up to for those contributions. So even if you take the standard deduction and you made $100 of charitable donations, you can still get a benefit for that. So please make sure you tell your tax preparer. Now, again, this is another opportunity at year end, typically, for some planning. Let's say you kind of straddle, between the standard deduction and the itemized deduction, and you find yourself to be charitably inclined. Maybe it makes sense every other year to make a large donation, which will then give you the benefit of the itemized in years, let's say the odd years. And on the even years, you take the standard deduction. So it's kind of like coupling or bunching up your charitable donations so that you're getting the benefit A of those charitable donations as far as being able to itemize, and B, you're obviously still contributing to those various organizations as you normally would.
I think that's all the questions we have for now.
That's right. Folks, I do believe that's all the time we have for questions. And as we're closing out, if you have another question, go ahead and put that in the chat. We'll go ahead and make sure that gets addressed. Make sure to leave your phone number as well. Well, this has been really informative, really interesting, and hopefully get people going and make sure take good care of our tax preparers. Thank you so much to Carly and Sean for being here, and thanks to the organizations that have made this webinar possible today. We will send out an email soon with a link to the replay of this event, and you're welcome to share that with your friends and family. And we would love for you to see that replay. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and anyone we introduce to our advisor partners will receive a free initial consultation. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Thanks, everyone.
Thank you.
Bye.